Hai and Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Hakim Iman bin Abdul Latif from JBA 2423A, and today I'm going to present about capital structure. So, firstly is, what is capital structure? Capital structure is the combination of multiple external funding sources, also referred to as capital, utilized to finance a business, is referred to as capital structure. It is listed in the balance sheet of the company and comprises of equity owned by shareholders, debt, and preferred shares. The firm is said to have more financial leverage if its debt component is greater than its other capital sources. How to determining optimal capital structure? Firstly, we need to minimize the weighted average cost of capital (WACC) to maximize its market value. The capital structure of a corporation should be selected to have a low WACC. The rationale behind this is that when the weighted average cost of capital is low, we are aware that one capital structure must be superior to another. The goal is to maximize the shareholders' wealth. There are 5 ways to determine optimal capital structure. It is using leverage ratios to find different capital structure, finding the cost of capital and the cost of debt, find the weighted average cost of capital, and achieving optimal capital structure using graphs. Factor affect capital structure and capital structure decision. The first is control. Capital shareholders have voting rights on the board of directors. The corporation must use its debt equity to maintain control. Next is leverage or stock trading affects EPS. Fixed income and diversified income sources provide the funds. The amount of the fixed sources of funding has an impact on shareholder returns. Life cycle stages. A startup company has a higher chance of failing. In the growth stage, its capital structure should be planned so it can raise money. Financial distress. Financial distress is an idea used in corporate finance to describe a situation when a company's obligations to its creditors are breached or difficulty maintained. Business at greater danger of financial will borrow less money than those at lower risk. The cost of financial crisis is largely determined by the company's assets. Companies are encouraged to borrow more if their assets are primarily tangible. Costs of financial distress include costs related to bankruptcies or poor business decisions made previously to bankruptcies. Financial distress involves a number of costs such as bankruptcy costs, losses from distressed asset sales, a higher cost of capital and direct costs, and conflicts of interest. Discussing the integration of tax effects and financial cost distress. To finance their operations, organizations borrow both short-term and long-term capital. When there is a corporate tax, debt raises a company's worth, according to Modigliani and Miller. The cost of bankruptcy can lower a company's total value. According to financial analysts and specialists' opinions and studies, companies' worth rises when it starts to move away from debt, and consider the potential effects of debt financing. The present value of the cost of debt increases with every little increase in that cost. The tax credit's present value may occasionally rise. Discussion of agency cost of equity. Agency cost of equity refers to the conflict of interest that rises between management and shareholders. When management makes decisions that might not be in the best interest of the firm and that shareholders view as an action that will not increase the value of their shares, an agency cost of equity has arisen. Company cost of capital also takes into account the expense that alerts managers to poor choices. This is an example of the agency cost of capital that a corporation must bear when owners and managers don't care about the company. Firm starts to borrow money from the market to finance its operations through debt rather than stock. This condition makes owners more motivated to avoid replacing capital with debt. Favorable conditions also reveal the capital cost of an institution. Excellent instances include free cash flow, personal usage of business automobiles, and other assets. Pecking order theory. Instead of establishing goal capital adequacy ratios, businesses modify their financial practices to reduce related expenses. In other words, retained earnings, borrowings, convertible bonds, and preferred stocks come first in the hierarchy, with the issuance of fresh capital coming last. Businesses first issue the safest securities when they need outside financing. Management significantly favors internal generation as a fresh source of money, while avoiding external funds, said Donaldson, the inventor of the hierarchy theory. Company cannot determine an ideal capital structure unless they can get into more detail about their real finance choices. And lastly, for the signaling hypothesis, companies' financial decisions are signals given to the investors by the firm's managers to break the asymmetries. Management will only issue debt or equity if there are insufficient internal sources to finance needed investments, finding trends in sort, level, and reliability of the information provided. Therefore, if the manager believes that the existing stock's price was below the stock's revenue, they will not issue more shares.